Could be 3 months, could be 6 months, but there is a recession coming. Hello, everybody. This is Dr. Richard Smith, aka the Doctor of Uncertainty, and this is Market Moves. A lot going on in the last couple of weeks since we last got together. Today, we're going to, of course, talk about the big picture. You know, that's always on my mind, talking about where markets are today and what's happening. And then finally, we're going to get into some changes to the model portfolio. Got some new ideas to add to the portfolio, some ideas to take away from the portfolio. And I'm going to show you how we've been advancing the FINIAC tools to help you and me build holy grail portfolios that can weather the storm. So let's get into it. We got a lot to talk about. And of course, I love starting with the big picture. So for a while, we've been talking about a few cycles-based themes that are going to unfold over years, if not decades. We've been talking about Ray Dalio's debt cycles, monetary policy 3, where the government just gives money to the public sector because, you know, monetary policy 1 and 2 don't work anymore. And now this week he's talking about civil war. We'll get to that in just a minute. Neil Howe's fourth turning is in play. We've got these generational cycles, and we're in the fourth turning right now. I'm going to get to interview Neil Howe in a few weeks on behalf of the Foundation for the Study of Cycles. Very excited about that. So if you've got questions that you think I might be interested in asking Neil, definitely would love to hear from you. And if you've read the fourth turning, looking forward to talking to Neil and hearing about your ideas. Of course, we've been talking about Peter Turchin's end time thesis, particularly the wealth gap and the declining well-being, the declining quality of life for most of the population, while you have this intra-elite competition. So most of the wars going on online are really between the overly educated class who are competing for a limited number of jobs. And we saw some new data on that this week, limited number of white-collar jobs. So we're talking about the yield curve is normalizing, right? So short-term rates are growing relative to long-term rates. We'll check in on that. That usually means a recession's coming. Stagflation is our most likely future. And then finally, we're living in an increasingly artificial world. And I'm going to be talking about my views there, where power is accumulated by going to extremes, polarization, to flush the pockets of the naive. And this is mostly the intra-elite competition that Peter Turchin has been talking about. So let's dig into it. We've been following this chart for a while. This is what happens. These are when the recessions happen, right? Then markets go down. We haven't had a recession yet, but we know that when this yield curve, right, the 10-year minus the 3-month, starts to normalize, starts to go back up, when short-term rates, 3-month rates start to rise relative to 10-year rates. If you're going to loan money for longer, you want to get paid more interest, right? But that's not the way it is right now. But we're starting to normalize way over here, right? Went down about 4% from the highs in this spread. And now we're starting to come back up, starting to normalize. That's when we get these recessions. And once we do start to normalize, we're going to get a recession. So could be 3 months, could be 6 months, but there is a recession coming. Here's what, just zooming in on this spread, this 10-year minus 3-month, we can see that it continues to normalize over the last couple of weeks, and it's not slowing down. And again, there is no soft landing ahead. Soft landing is, I have no idea where that came from. So let me just tell you briefly, this is the yield curve over the last 1, 2, 3, 4, 5 months. So again, down along the bottom here, we got 3-month yields at about 5.5% today. This was as of October 11th. And going down, the 2-year was at 5%. The 5-year was at 4.6%, right? 30 years, we're out here at 4.7%. So our 3 months right here are still higher than our 10-year right here. But if we look back 1 month ago, the yield curve looked like this, okay? And if we look back 2 months ago, it looked like this. So what we see happening is that over the past 5 months, this was June, July, August, September, October, the longer end of the curve, right? The 10-year yield, the 30-year yield, these have all been coming up, right? So yields have been going up on longer term debt, while yields have been staying pretty steady on shorter term debt. Longer term rates have been going up over the past 5 months, which means bonds are selling off. Longer term bonds, 10-year notes, treasury bonds have been selling off. So the yields are going higher, means people are less confident about the future of getting paid back by the government. So those yields are going up. It's not about confidence, it's about losing confidence. Meanwhile, over here, on the short end of the curve in the 3 months, they've been staying about the same, not going down. If the economy were really picking up steam right now, we'd expect these 3-month rates to be going down because people would be taking their money out of the safe stuff and putting it into the markets, et cetera. But that's not happening. So this is called a bear steepening. Yes, the yield curve is less inverted today than it was back in June, but that's only because the long end of the curve is starting to go, yields are going higher. So that's not really what we want to see when we're looking for a robust, rapid recovery. But it is still normalization. The 3-month is getting less ahead of the 10-year. So sorry for all that confusion. I know it's confusing. It's a lot to keep track of, but it's very important to understand. We're still in the middle of yield curve normalization, and we've got a bear steepening. So next time somebody asks you, you can sound like you know what you're talking about. All right, this is a new piece by Ray Dalio out this week on the coming Civil War. The failure of Kevin McCarthy is another step away from democracy and toward civil war. Government is not functioning. One congressman is able to throw a wrench into the entire U.S. Congress, more or less. We don't have a Congress. We don't have a Speaker of the House today. This is signs of an increasingly brittle system, signs where one person can disrupt an institution that's been working for hundreds of years. So this is not a good sign, and it fits into Dalio's thesis that there's more fighting ahead, and this is the wrong direction. Going back to Peter Turchin's thesis about the intra-elites competing, too many college-educated people competing for too few white-collar jobs. The hot labor market isn't helping a certain group of job seekers. Underneath blockbuster top-line data about new jobs is a not-so-rosy reality. White-collar jobs are getting tougher to land. So yes, we had a blowout jobs report this past week, last week, but meanwhile, white-collar jobs are getting harder to land, and those are the jobs that people want. More on this theme of polarization and intra-elite competition. Here we've got our two presidential candidates, Joe Biden and Donald Trump, and these are both images that they put out from their own campaigns, right? I'm not bad-mouthing either of them here. I'm just showing you what our politics has come to. Polarization is the business model of today, and we'll see more about that as we progress. We've got the Sam Bankman-Fried trial going on. I mean, I look at these two people, Sam Bankman-Fried and Caroline Ellison, and I can't believe that this is who we put in charge of billions and billions of dollars. But Ellison said of Fried, Bankman-Fried, he thought the only moral rule that mattered was doing whatever would maximize the utility. When I started working at Alameda, I don't think I would have believed if you told me I would be sending false balance sheets to our lenders or taking customer money, Ellison added. But over time, it was something I felt more comfortable with. Okay. So this is the idea of effective altruism, that Sam Bankman-Fried was going to single-handedly save the world, so it didn't matter if he lied to everyone. along the way because he was doing good. He was maximizing the utility. So personal responsibility out the window. This is absolute lunacy. Again, we are unmoored from reality here. And watching this trial unfold is certainly more evidence of that. You know, another thing Caroline Ellison said was, oh, he wore the shorts and the t-shirt and the crazy hair because he thought it would help the business and help us help more people, right? Again, it's all an illusion. Or yeah, he drove luxury cars for a while, but then he said, no, I need to drive a Corolla because then people are gonna still think that I'm an effect, that I'm out to help people, right? No, it's all an image. We're living in a world of imagery. It's a brittle, increasingly brittle world. And this was a great piece out of Bloomberg on his parents, Meet the Parents, about how his parents, Stanford law school professors, opened doors for their son and provided a halo effect for his company. And loved this piece by his mother, Barbara Freed. Beyond blame, the philosophy of personal responsibility has ruined criminal justice and economic policy. It's time to move past blame. So this isn't her son's fault. This isn't Sam Bankman-Fried's fault. He's not personally responsible. He was a victim of his conditions. Personal responsibility should not be part of our criminal justice and economic policies. So this is the world that we live in today. It's not very stable, right? We saw this interesting exchange between Lex Friedman and Mark Zuckerberg this week, showing Zuckerberg's new metaverse technology with photorealistic avatars. And so these are pictures of these two talking to each other in the metaverse. Look, it looks pretty cool, but I'm telling you, it's unhinged. It's unmoored from reality. This is not real. I don't care how photorealistic the images are. It's not real. We're not living in the real world. And because we're living in this artificial world, that's what we're living in. It only takes, a small event to disrupt the whole thing. Unfortunately, we saw a devastating small group of people disrupt the whole globe and especially the Middle East. And again, this is competition between the rulers of these two people, and the people are the victims. We've been looking at the wealth gap. Top 1%. These two green swaths controlling, 30% plus of the wealth in the country. And that's a 40% gain in how much wealth they control over the past 30 years. We saw this week SoftBank's founder and Vision Fund founder Masayoshi-san come out and say, artificial intelligence will soon surpass humans. With the screen behind him showing a photo of a goldfish trapped in a bowl and looking at a question mark, he made it clear what he thought the audience would become if they chose not to adopt AI in their lives. Do you want to be a goldfish? He said. Those who stay away from AI and those who use it will grow to be as different as an ape and a human being in their intellectual capacities, he added. So this is Masayoshi-san, the god, and you, the goldfish, unless you buy his products and use his technology. Folks, this is nuts. I'm all for artificial intelligence. It's a new technology. That's it. It's not human. It's not a god. You're not going to be a god if you use it. You can do your job better, yes, if you're a knowledge worker, but you're not going to be a goldfish if you don't use it, and you're not going to be an ape, and he's not going to be a god. So this artificial world, this polarized world that we're living in is not sustainable. This generative AI technology is only going to exacerbate the wealth gap more. All of this is feeding into the crises as articulated by Dalio, Howe and Turchin and others. And this is what we need to be on the lookout for and making sure we stay away from. So what's going on in markets today? We've got the seasonal volatility, which should now start to decline. We talked about that last time. Again, the normalization of the yield curve. We've got a bear steepening. You know what that is now. Don't see a soft landing. Going back to 1982, there's going to be a recession. Cycles are shifting bullish for equities and treasuries. Time to start nibbling if you're looking to establish some long-term positions. Bias and diversify your portfolio towards rebuilding the real world. So, showed this chart last time, a couple weeks ago. Peaking volatility here in October probably happened last week. Friday, that jobs report came out last week. It was the perfect setup for a significant crash, but instead we got a big reversal during the day, and looks like the October lows are in, and volatility should start to decline. This was the scary chart put out by John Authors about what could happen on Monday, but we didn't get it. The NASDAQ did not crash in 2023. 2023 is not over, but we're going into a seasonally very bullish time. This is the last 3 months of the year, October, November, December. Average performance over the past 33 years from 1990 to 2023, the stock market is up from the second week of October through the end of December, even a little bit into the first or second week of January. So bullish seasonality is now here. Doesn't mean bad things can't happen, but odds are against it. Need to be leaning bullish for the next few months. This is showing the October lows over the last few years, 2019 here, 2020 here, 2021 here, 2022 here. Were those the October lows for 2023 last week? I think it's a good chance. This was that intraday swing, right? We got after the jobs report, got a gap down here. Looked like we could be heading over the falls, but instead turned around and rallied massively, and probably put in those October lows. So got to be leaning bullish here on equities. Treasuries have, I think, had a bit of an exhaustion move too. Probably will rally for a little while, bring yields down overall. But we still believe there's a recession ahead. So we're going to take a look at how the economic cycles, okay, this is from the Visual Capitalist, I believe. Get the peak, we got a slowdown, which is what I think we're in right now, into a recession or a trough, recovery, and expansion. So where are we in the cycle? I think we're here heading into a recession, bottoming sometime next year, more than likely, and then recovery and expansion until the cycle starts over again. So this shows what sectors tend to do well in different environments. So during recessions, real estate doesn't do very well. Technology doesn't do very well. During recovery, real estate does great. Technology does great. Right now, I think we're in the slowdown phase. Fade real estate, favor healthcare, utilities, consumer staples, energy, right? Then going into a recession, still consumer staples, utilities, healthcare, energy, these are defensives. So I think we want to be favoring these defensives right now as we enter the slowdown, head into the recession, and then as we get to recovery, start to shift out into sectors that do well in the recovery. But I don't think we're there yet. So I am battening down the hatches and getting defensive. But of course, I also want to have a balanced portfolio. So we've been talking about how to identify great stock pickers using 13F filings. We've identified half a dozen or 8 or so that are stock pickers. They have 10 to 75 holdings, okay, not hundreds of holdings. 50% of their holdings represent are in the top 10 stocks in their portfolio. So they've got some concentration, they've got conviction. Their average holding period is longer than 3 years. We want a robust long-term portfolio. And the 3-year performance is greater than at least 10% annualized. So that's how we picked out some of these asset managers: Shaw Capital Management, Fairholme Capital Management, Old West Investment, Kopernik Global Investors, Oaktop Capital Management, and Drexel Morgan and Company. This is free, folks. These are 13F filings. They tell you what's in their portfolio. You can go see it for free at whalewisdom.com. And so we have identified some potential investments on the theme of rebuilding the real world. That's hat tip to Neil Howe on that one of The Fourth Turning is Here. Got to ask him, what do you invest in during the fourth turning? Well, it's really about coming out of the fourth turning when we start rebuilding the real world. And so these are some potential ideas that, doing my research, came across, said I would consider adding these to my portfolio. Palladium, brought to my attention by my friend and fellow FSC board member Jake Bernstein, supporting a turn from 6-year lows being accumulated by institutions, mostly used for catalytic converters. Abbott Labs in the healthcare, okay, owned by Old West and Drexel Morgan. Good defensive. And again, these are just candidate ideas. Analog devices, chips for the AI cloud, picks and shovels, right? They're making the real world parts that make the metaverse run. My friend DR Barton loves this stock, converts real world analog signals into digital data and back again. It's also a top 3 pick of Oaktop, one of the asset managers we're following. AT&T, infrastructure, services, and media, and a 7% dividend, the top held stock of Drexel Morgan. Otis Worldwide, industrial sector, elevators and escalators, right? That's rebuilding the real world, owned by 2 of the asset managers we're following, Drexel Morgan and BLS Capital. Caterpillar, equipment for construction and mining, owned by a couple of great stock pickers, Drexel Morgan and Old West. Cameco, the uranium company, I think nuclear power is certainly part of the future. Old West and Kopernik. And finally, Coca-Cola, consumer staple, the ultimate consumer staple, loved by Buffett and also owned by Kopernik, Drexel Morgan, BLS, and Greenhaven. So these folks know what's coming. And so we're going to jump over here now to FINIAC. And what I'm going to show you now are some new tools that aren't yet available. These are still in beta, but we're going to use them, and they're going to be available soon to everyone. We're going to start using them to shift up our portfolio. Here's what we started with. This was our portfolio built back at the end of 23 Q1. And, we've got Apple, Bristol Myers, Bitcoin, commodities, some energy plays, Fair Isaac, etc. So we've basically taken this portfolio, made a copy of it, and we're calling it 23Q3. And it's based on the 7 principles of successful investing. So now I'm going to show you how we can start thinking about this portfolio and making some changes to it using these tools and thinking over the long term. So right now, this is based on 1-day data, but one of the new features that's going to be available soon is that you can change time frames. And I want you to see how big a difference this makes. The exposure and the volatility here, the exposure, $498.61. These are some new metrics: diversification score and exposure. These are things I've been working on intensively for the past year. I use them myself in my investing and my trading. Very excited about these. Diversification score is telling you how diversified your portfolio is. And exposure is basically telling you kind of for your portfolio as a whole, what happens if everything goes against you for 10 periods in a row, in this case, 10 days in a row. So $500 loss on about a $15,000 portfolio here over 10 days. That's going to hurt, right? But it's not going to be the end of the world. But look what happens when I change to looking at every 5 days instead of every 1 day. So this is now weekly data instead of daily data. Diversification score is still around 60%. That's good. But the exposure, right? If things go against me 10 weeks in a row instead of 10 days in a row, I could have a loss or a gain. It's just volatility, right? Of $2,164. So that's a bigger deal. Over a 10-week period, things change. So we're going to stay focused on the weekly data because we want to build a portfolio that we're going to be able to stay in for a few years, at least, preferably 5 or more. So now we're going to go over to the workshop. Again, this is a new feature, not available to the public yet, in beta, but coming along. And so here I've got the portfolio. Here I've got my metrics up here. And then down here, I've got a collection. And I've made a collection of my top ideas: Abbott, ADI, Caterpillar, Cameco, Coca-Cola, Otis, Palladium, AT&T, and I also added TLT to go long bonds instead of short bonds. So here I can start playing around and deciding what to remove and what to add to this portfolio and see how it impacts, particularly my diversification score and my exposure. So I am ready to lighten up on my technology. I think NVIDIA has been overdone, and I want to remove it from the portfolio. So I just removed it. It really didn't impact my volatility or my growth. It did lower my diversification a bit and lowered my exposure, but I'm okay with that, right? Selling at a high is okay sometimes. I don't want to be short bonds right now. I think that the sell-off in the bonds has run its course for a little while. So going to remove bonds, short bonds from this portfolio. Yes, that hurt my diversification score because those short bonds were adding a lot of diversification to the portfolio because they weren't very correlated. And finally, I'm also going to take Apple out of the portfolio. Again, lowers my diversification score, but that's okay. I've got more to add. And Fair Isaac, it's in the financials. It's up a lot. Doesn't mean I have to sell it. Financials do well during this slowdown period, so probably hold on to it a little while longer. So with this remaining portfolio, now let's look at what we might add. One of the things I like to do right away is sort by correlation and find the opportunities that are minimally correlated, not negatively correlated. Okay, it's okay if they are. Might be okay. Anything minus 30 to plus 30 is usually kind of in the sweet spot, but Cameco and Caterpillar are both highly correlated to the portfolio here. So let's look kind of between minus 30 and plus 30. All of these are potentials. I think some long bonds right now for the next 6 months or so are interesting, and they're negatively correlated. So if I add that to the portfolio, increases my diversification back to 41. Coca-Cola, pretty minimally correlated, consumer staple, good in slowdowns and recessions. Abbott Labs for healthcare. So if you can see what I'm doing here, I've exited some positions that I think, one, are kind of contributing to our artificial world a bit too much, but also I want to invest in rebuilding the real world and not so much in these kind of fantasy experiences that we seem to love so much. What else here? AT&T. Yes, it's a telecom company, but it's more of an infrastructure company, right? They're providing the pipes. And lastly, palladium, a material. We're getting back up there. So each time I've been looking, does my diversification go up? Does my exposure stay about the same? Starting to like what I see here. And lastly, I really like this Otis idea. I think it's part of rebuilding the real world theme. And again, raises my diversification score, doesn't hurt my exposure too much. This is a pretty good new portfolio. I'm going to save it. Let's go back and see what we've got now. Now we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 stocks. Still got Bitcoin in here. Yes, I realize that's not necessarily rebuilding the real world, but I do think Bitcoin's in a good spot to rally over the next 3 to 6 months. So these are some adjustments to the portfolio, also showing you the new FINIAC tools. It's based on my particular beliefs about the future and my risk tolerance, and the fact that I love Ray Dalio's idea of Holy Grail portfolios. But this is all going to be available to the public soon. So if you're not signed up for FINIAC yet, please do. Let's jump back to our presentation and just remind ourselves, big picture, we've got debt cycles, monetary policy 3, and increasing conflict. I'm not talking about necessarily, 1860s Civil War, but a lot of institutional failure, let's say. We've got the fourth turning happening, these generational changes, going through conflict, looking for new structure, new agreements, new path for moving forward. We've got most of the population declining in wealth, declining in health, and too many college-educated people competing for too few white-collar management jobs. The yield curves normalizing, stagflation, and we're living in an increasingly artificial world that is really driven by kind of events at the margin where a few people can do, very disturbing, disruptive things, get a lot of attention, and kind of make life miserable for everyone. We've got seasonal volatility starting to decline. Yes, the normalization of the yield curve. We're going into the bullish seasonal time, but there will be a recession in the next 6 to 12 months. Cycles are shifting short term for bullish and for treasuries, and we've made some adjustments to our portfolio. Definitely time to start nibbling if you're looking to establish some long-term positions. So, covered a lot, folks. Always want to look at the big picture, get a sense of where markets are today, and then make sure we're managing our portfolios like the pros. So thanks for sticking with me. I know it's been a lot of information. We only get together every 2 weeks, so I got to give you all I got. Really appreciate it and look forward to catching up with you again in the next couple of weeks.